Welcome to part 3, the final video in my series Investing for Beginners. Really, it's for all investors though. Part 1 was building a strong foundation for investing. Part 2 was all about financials, so now we're going to cover the remaining items on my quality checklist. I created this quality checklist to ensure I'm picking the best of the best stocks for my portfolio. These items are what I feel ensures a company will produce growing profits that equate to your investment in the company growing and outperforming the general market. So if you missed the first 2 videos, be sure to watch those as it all contributes in creating a portfolio that is likely to make you wealthy and create financial freedom. So the remaining items we will discuss today are a good management team, positive brand recognition, products and services, the moat of a company, and we will talk about valuation. Let's start with a good management team, and we're going to start with a fun exercise. Look at these CEOs. Which ones are instantly recognizable and which ones are not? Now, the recognizable ones, do you have a positive view on them or a negative one? Do you respect any of them as you feel they have been a good leader of the company? Do you think any have been a bad leader of the company? Are all your views from social media or actual research of their actions? These are all questions you should answer when thinking about the leadership of a company. And if you deem that the leadership, aka management, makes good decisions, is a good advocate for the company, is a leadership style you feel will take the company to new levels, is controversial in a good way or maybe a bad way, brings risk to the company, uses and reinvests their free cash flows and profits in a way that benefit the company's future, etc., etc. So let me reveal the names and companies they are the CEO for. Of course, top left, Tesla, we have Elon Musk. Upper right, we have the prior CEO of Disney, Bob Chapek. Then the bottom left, we have Microsoft CEO, Satya Nadella. And then the bottom right is Mike Roman. He's the CEO of 3M. So let's take Elon Musk for example. If you did not know this one, then maybe you have been living a solitude life on a remote island for a decade and just started to come out and decided to invest. So welcome to the world. He is the CEO of Tesla, and one that you all probably instantly recognized, probably the most recognizable one on this list and probably in the whole stock market. He is a very outspoken person and the face of Tesla. He is usually surrounded by controversy. You may feel that his bold personality is a positive for Tesla, or you may feel it is a negative and brings risk for the company. So far, this is what people expect out of Elon, and they like his bold approach, and any controversy that's negative or positive does not seem to scare investors. On the other hand, you have the prior CEO of Disney, Bob Chapek, who tried to be outspoken and ended in a battle with the Florida governor, and that was a large contribution in the decline in Disney stock. So some leaders' personalities and actions are a powerful driver of growth for the company where investors see strength, and other leaders' personalities and actions do not bring confidence to investors. Now, Satya Nadella is well known in the investing world. Of course, he's the CEO of Microsoft, but he is not controversial and is not one to project himself into the limelight. So maybe that is your preferred type of CEO. Now, Mike Roman of 3M is not very well known, but his company's poor performance and lawsuits are. He was also in the news recently for taking a $26 million pension while cutting retirement benefits for workers and increasing benefits for executives. I have read over and over the last several years how the morale at 3M is low, and I can see why. Really, is this the type of CEO that you want? Not me. So get to know who is running the company you buy stock in. Now, looking at financials of the company does reflect management's decisions, so everything in my prior video on financials is also a good way to measure how management is utilizing and managing its company's financials to spur growth and returns for investors. I would say one of the most important things to look into is how they use the free cash flows of the company. What is the money going towards each quarter? Also, is the company that of integrity, so honesty and transparency? Is it a company that investors can have reliance on to generate profits? Does the company have any legal issues? And how do they demonstrate social responsibility? And do they move with a high level of security, keeping their company and stakeholders safe from risks and exposures that can be detrimental to its future? These are all things to look at to measure how good management is at leading and growing the company and proving they are capable of continued success that is worth your invested dollars. Now let's move on to the next item. That's positive brand recognition. Again, Disney right now is trying to patch their negative brand recognition of underwhelming remakes, losing their magic and getting involved in politics, something they should have handled differently or stayed out of altogether. This negative brand recognition has hurt their stock performance, put future revenues and growth potential at risk, and is now what they have to spend their attention on. Instead of building on prior success, they are trying to build back up that success. Companies with positive brand recognition are those like Apple and Amazon. People love Amazon and Apple, utilize them daily, are happy to use their convenient products and services. They line up to buy a phone or wait for Amazon Prime Days to order all their gifts online. This is because they have built up trust, created positive customer interactions, and these companies with a positive brand recognition have staying power and are likely to grow and keep growing well into the future. So I look for a company that has positive brand recognition. And sometimes that's just in a specific industry, might not be worldwide, so you need to put it in perspective as well. Now let's talk about products and services. Know your companies and what they offer. What are their products and services? Some people invest because of FOMO, fear of missing out, or because someone else says to, but they have no idea what the company really does or offers. I see it all the time. So make sure you know what products and services these companies you are investing in offers. And better yet, make sure those products and services are superior to other companies. So you want to look for products and services that create repeat customers. Take Costco, for example. They have a high retention rate with their memberships, and once you go Costco, you don't go back. Why? Because they offer something unique that adds value and makes customers want to return over and over again. Costco goes out of their way to offer unique things like gold bars that sold out. They work with vendors to offer items that are unique to Costco so that you cannot get them anywhere else. They offer perks like $1.50 hot dogs and inexpensive quality gasoline. Really, once someone signs up to become a member at Costco, they stay a member, and that creates a repeat customer. A great thing to have as a company. This is also creating a sticky subscription or membership where the company can rely on dependable growing revenue, one of the things I love most about companies I invest in. You don't want a company where someone feels they no longer need to pay for their subscription because it does not add any value to their lives. You want a company that offers a superior product or service that will bring the customer back over and over again. You also want to invest in a company that offers a product or service that a customer depends on. So let's say their phone. I know not many people would choose not to have a phone these days. That leads to the ecosystem, and for this, Apple is an excellent example. Not only are their customers dependent on their product, they are now entered into an ecosystem of other Apple products and services that they are most likely to purchase and use long term. You buy the phone, then you're likely to buy the watch, the AirPods, Apple TV, Apple Music, etc., etc. This is because Apple makes quality products that seamlessly work with each other. They have created an insanely good ecosystem, and the further a customer is in their ecosystem, the harder it will be for them to leave, and that is gold for investors, and this usually equates to long-term growth. So know the products and services of the company you invest in and how strong those products and services are at creating long-term customers. Now let's talk about the moat of a company. It's a protective barrier that prevents competition from eating at its market share. An effective moat is one where a company has a competitive advantage. So say with Microsoft, it's Office products that dominate the business industry, or Amazon with Amazon Web Services that is dominating the cloud business. These companies are experts in what they do, and customers know it, and therefore will usually always prefer their product as no one else offers something close to theirs. So Microsoft and Amazon enjoy the fact that most customers will see their competitive advantage and will just choose them for that reason alone. Monopolies are another big part of a company's moat. Those that take the top spot, or even sometimes one of the top 3 spots, so a duopoly or triopoly, will always have an advantage as they are the only one or one of the few that provides a specific product or service. This provides investors that sleep at night feel, as they know the company they own dominates in an area that others will not likely dare compete in. These factors all ensure that your company is hard to replicate or disrupt, and that is powerful. Is what they provide so complex, expensive, and are perfected that few can set up a business in that area, let alone compete? Think about it. If you were given $1 million to compete against Microsoft or Zoom, which one would you feel you would be more successful at competing against? Well, Zoom obviously, as it would be easier to create a video communications business as compared to a giant software business, along with intelligent cloud offerings, business processes, security services, talent acquisition, marketing, gaming, plus video communications, and so much more. So ensure your company has a wide moat. Now, let's talk about a good valuation. A quality company usually trades at a premium. I hear too often that a company is too expensive, yet it keeps climbing to new highs after new highs. This is where your research comes into play. The first type of research you can do is financial research. We saw this in the last video, my stock facts label on Microsoft. So I would use this to see that the PE ratio over the trailing 12 months is much higher than the last 5-year average. Maybe take this out to 10 years and do a comparison as well. Also, compared to other companies in that same industry. Right now, I personally feel Microsoft has raced up too high, too fast, and will have a correction at some point, in which I will then be a buyer of Microsoft. Look at other ratios as well at current points in time versus historical averages to get a sense of its valuation. Then, very importantly, apply those valuation metrics to what the company is doing now versus the future. So with Microsoft, the main reason it has jumped up so high in valuation is due to its venture and investment into AI, artificial intelligence, that it is integrating into almost all its products and services. So maybe it is deserving of a higher valuation, or maybe you think there will be another main player that will take the top spot in AI over Microsoft, or you feel AI is just overblown as a promise of generating future growing revenues. So if you're bullish on AI, then maybe it's okay to buy Microsoft right now, or not, then maybe you wait. So I am bullish on AI and think it will significantly benefit Microsoft in the future, but I still feel it is overvalued currently when factoring in all my analysis. So I decided on a price target approach. If Microsoft falls below $300 per share, that's my buy-in price. That is where I feel Microsoft will then be slightly undervalued and worth my dollars. So a good valuation is all about your research and analysis on its current numbers and business potential based on the things it is doing today. Okay, so this is how I invest. Choose quality companies that have created great gains in my portfolio, and here's my portfolio. I contribute its almost 21% gains or 27% growth over the last year to my quality checklist, which, by the way, if you missed my last video on financials, that is a must to watch and will be very beneficial. But here are my companies, and all were chosen using my quality checklist except 3, and of course those are the 3 in the red, which shows me so far my strategy is working. So if you have any questions on any of these companies that I hold in my portfolio, just let me know. So I hope you enjoyed my 3-part series on investing with a focus on investing for beginners. Investing is a great way to create wealth, so do not be afraid of it. Just be willing to be patient and learn as you go. The hardest part is getting started. So open up an account, fund it, and maybe buy an S&P 500 exchange traded fund, ETF, like VOO first, then slowly get into individual stocks. Buy quality and plan to keep your stocks long term. This world is full of fear that makes investors impulse sell and buy. Don't fall into that. Be confident in your methods, utilize my approach, but also make it your own. Let's all get wealthy together, create passive income to ease our reliance on one source of income. And on this channel, I really aim to help by sharing everything I know that I feel will benefit you by being transparent and honest by always showing my investments. So subscribe, try out my channel, and as always, I appreciate your support. It means a lot. So let me know how your investing journey is going. I'd love to hear and have us all encourage each other. Mine is 4 years in, some decent mistakes in my first year and a half, but I have learned a lot and am now reaping the benefits of what I have learned and applied. I will make more mistakes, but I will share those and I will learn from them and come out stronger and stronger each time. Okay, well, that is all for today. Happy investing, and we will see you soon right here on Mark Arnold's Finance. Have a good day.